Bob Elliott of Unlimited joins us now for more. Bob, good to see you.
Good to see you.
How much changed this week for the global economy?
Well, I think we've basically doubled down on the pursuit of overly easy monetary fiscal policy in the U.S. And that's a big deal ahead, particularly because the consequences of the overly easy fiscal policy are probably not going to be meaningfully felt in time for the Fed to arrest their planned 100 or 150 basis point cuts, given the timing. And the Fed can't really act on prospective fiscal policy until it actually happens, and that won't happen until later in 25.
If it doesn't shape direction, will it shape pace? We just had a conversation about maybe going 50 in December. If you're the Federal Reserve and you face the very real risk of things turning the other way, do you have to slow down that pursuit of neutral?
I think they're going to be looking. The Fed's backward looking, and they have to be backward looking because they have been so poor at trying to predict what's likely to transpire, and have learned their lesson as a result. So they're going to be looking at the actual data, combined with the fact that they strongly believe that inflation is over, and so the cuts will come. Is it 50 or 25 in any particular meeting? It doesn't really matter that much, particularly for the equity market or growth. The direction of travel is clear. Rates are going down, even if inflation continues to be elevated relative to the mandate, even if growth continues to be pretty good. They're cutting rates because they believe that inflation is dead.
So do you buy into that notion, or do you go the opposite direction and say inflation is alive and well, and these are the ways that I want to play it?
Yeah, well, I think if you look at the actual data, right, core PCE is 2.7%. That is above the Fed's mandate. The Fed is unlikely to actually meet its SEP goals for December as a function of that. We continue to have a relatively tight labor market, maybe not quite as tight as it was before, but still tight. We're seeing those unit labor costs rise in the data that we saw this morning. All of that points to elevated inflation pressures ahead. If the Fed is going to continue to pursue this over-easy monetary policy, the solution's pretty clear, which is you want to buy equities and you want to buy gold and you want to sell bonds.
And so at this point, I guess this is what we're trying to parse through. How much is the course of the economy from before what people are currently looking, and basically a sigh of relief? We know what happened with the election. Regardless of the outcome, we know we have an outcome, we can move on, versus that there is actually going to be a growth shock from the new policy. How much is that growth shock already being priced in?
Yeah, I mean, what's priced in, if you just look at the post-election indications, are essentially, the equivalent of a upside growth data point, like a non-farm payrolls that was better than expectations. So incrementally expecting to see stronger growth, but there's a long way to go in terms of the pricing of a stronger growth environment with easier fiscal and easier monetary policy ahead.